Hey guys, it's Sasha. The Magnificent 7 stocks collapsed in the second half of July. Nvidia is down 17% after briefly becoming the most valuable company in the world. Tesla is down 12%, Facebook is down 14%, and Google is down 11%. Amazon and Microsoft are both down 8 and 9% as I'm recording this video, and Apple is the best performing of the 7 big tech stocks. Apple is only down 7%. A few days ago, Google reported their earnings, and the share price fell 8% immediately after. And it wasn't because of overall performance. Revenue was up 14% year on year, and Google also posted their highest ever earnings per share. But investors appear to be spooked by the amount of money Google is spending on AI. Capital expenditures in the most recent quarter increased to $13.2 billion. That's a 91% year-on-year increase. And in their 10Q on page 45, Google said, "Our capital investments in property and equipment consist primarily of the following major categories. Number one, technical infrastructure, which consists of our investment in servers and network equipment for computing, storage, and networking requirements for ongoing business activities, including AI, and data center land and building construction." A year ago, Google spent 24% of their operating cash flow on capital expenditures. Now that number is 49%. Almost half of the cash that Google's entire business is generating right now is being spent on things like building data centers for AI. On the earnings call, Sundar Pichai, the CEO of Alphabet, Google's parent company, opened up by saying, "People who are looking for help with complex topics are engaging more and keep coming back for AI overviews. And we see even higher engagement from younger users aged 18 to 24 when they use search with AI overviews." This sounded pretty interesting because, well, every single bit of data that I have seen that didn't come out of Google's backside says the exact opposite. So I thought I would look up Google's own data about this engagement. And where better to look than, the most recent 10Q submission, the long document that Google submits to the SEC every quarter. The word engagement, or any version of that word, only appears 3 times in this document. Once to talk about Google employees that are engaged in sales and marketing, which is irrelevant, and twice in this paragraph. Paid clicks represent engagement by users and include clicks on advertisements by end users on Google search properties. And other Google-owned and operated properties include Gmail, Google Maps, and Google Play. Cost per click is defined as click-driven revenues divided by a total number of paid clicks and represents the average amount we charge advertisers for each engagement by users. So when Sundar Pichai says engagement is up, I can only presume, based on Google's own definitions, that what he means is that more people are clicking on Google ads, because Google search is now so atrociously shit that it's impossible to find what you're looking for in the actual search results. On page 38 of Google's 10Q, they have this table. It shows that paid clicks on Google search, people clicking on Google ads, increased by 6% in the last year. But at the same time, impressions on Google Network have dropped 17%. Now, Google Network is the name for ads that you see on websites that are not Google. The banner ads when you read a useful blog or a useful informational website, things like that. So you can see what's happening through this data. Google is stopping sending people to actual websites to get their information. Instead, Google wants users to stay on Google and keep searching over and over and over when they can't find the thing they're looking for, the thing that used to be very easy to find 3 or 4 years ago. Because if the user gets frustrated enough by being shown dumbass AI snippets, 15-year-old Reddit threads, and Forbes at the top of every single search query, then eventually they might be so annoyed that they will actually click on an ad. Ads on Google search are worth a lot more than ads on websites, so it makes a whole lot of commercial sense. Google makes a lot more money by keeping you on Google instead of sending you to another website and serving you banner ads over there. When it came to questions on the earnings call, Ross Sandler from Barclays asked a long question. How are we thinking about the return on invested capital with this AI capex cycle? And Sundar Pichai said, "Look, obviously we are at an early stage of what I view as a very transformative area. The one way I think about it is when you go through a curve like this, the risk of underinvesting is dramatically greater than the risk of overinvesting for us here. Even in scenarios where if it turns out we are overinvesting, these are infrastructure which are widely useful for us, they have long useful lives, and we can apply it across and we can work through that. But I think not investing to be at the front here, I think definitely has much more significant downsides. And this is the general attitude in Silicon Valley. Everyone is investing billions in AI. If company over there invests billions, you've got to invest twice as much or 3 times as much to show that you are at the forefront. If you don't invest billions in AI, then you are labeled as a dinosaur and you will look dumb in front of your tech bro friends next time you are at a gathering. So you might as well spend tens of billions of dollars on building insanely huge AI data centers, even if you don't have a particular use case or know whether you're going to make any money from it because, well, fear of missing out. The problem for Google and the rest of the Magnificent Seven is that while they are all out there spending those tens of billions of dollars on AI, investors are now beginning to ask the question, where is the payoff? When is the payoff? Where are the big performance gains? Where are the massive step changes in user experience? Where are the new revenue streams? After Google's results came out, all tech stocks fell in unison to post the worst trading day on the Nasdaq in 18 months. And the high interest rates are not helping. Although the economy numbers overall look fine, people are putting off spending money on big purchases and on non-essential purchases. Look at the results of car manufacturers as one example. Tesla's automotive revenue is down 7% year on year. Stock is down 12%. Stellantis, the company that makes Jeep and Chrysler, just fell down 11%. GM is also 11% down, and Ford had one of its worst days ever. The stock is down 23%. The economy is under severe pressure because the interest rates have been held too high for too long. People are still buying things that they have to buy, things like food, because, well, you don't have an option. And remember, food inflation, shelter inflation, and energy inflation have all been higher than average. So when you see overall economy numbers, things look fine. US GDP grew 2.8% in the second quarter, above expectations. Everyone's out there celebrating. And the Fed will look at this data and say, look, interest rates don't need to come down. Everything is just fine and dandy. The economy is doing great because the overall GDP number is discounted by average inflation. It is not split up and discounted separately for the different parts of the economy. We can see that spend on things like food, energy, and rent are up significantly, but at the same time, spend on things like new cars is down significantly. When you add them up, you can't see that big difference because the average is doing fine. So even if you strip out demand on non-essentials like new cars, the economy on average looks like it's growing, but this growth is now just coming from inflation, and this is really bad. Big tech is squeezing the lemon to keep posting profit growth. Google now shows you 4 sponsored ads and the AI snippet before you get to any actual search results, and those results suck as well. They're so bad so that you can keep coming back to Google to keep trying to find the thing you're looking for. The search monopoly is so strong and there are no serious alternatives. Netflix has been threatening its customers with lawsuits for sharing their password with their family so that more people go and create new accounts. Nvidia is selling its GPUs for 4 times the previous retail price because the queue of tech bros wanting to buy GPUs is stretching around the block. But is all of this real growth? Is this actual growth, in a real economy? Is this an increase in productivity? Is this an increase in the way that the economy functions? Is this growth coming from all of these things? In many cases, the answer is no, not really. And now, about a year too late, suddenly investors are noticing something. Something smells a bit funny, right? Something just doesn't look quite right. Economy numbers overall look fine, but money has been burned on AI for 2 years now with no commercial wins. Entire sectors are doing pretty badly. And, sure, ChatGPT is very, very useful for some things. But does that necessarily mean that large language models are worth trillions of dollars in company valuations? Tech bros will argue, well, of course, because it is a generational change. This is the biggest change the world's ever seen, blah, blah, blah. But when pressed, there is no quantitatively derived value other than, it's the future, bro. At the moment, every company spending billions on large language models is actively losing money on that spend. OpenAI collected $13 billion from Microsoft recently, but is now on track to burn $5 billion out of that this year. According to recent reports, $1.5 billion is being spent on just salaries alone. And OpenAI is by far the most commercially successful LLM company out there. The obvious big question is, what is their moat when much smaller competitors are able to match OpenAI models on performance? Some competitors like Facebook are putting their models out there for free. There is a lot of talk about general AI and how these large language models are about to become orders of magnitude smarter. If you don't understand that, you're just too stupid, you don't understand AI, you're a dinosaur. But in reality, very little has actually changed in the 2 years since ChatGPT first arrived. The recent models are not even improving the quality of the output. In fact, they are doing the opposite. GPT-4o is faster than 4. A lot of people prefer that, but the quality of the output has got worse. It can process images, it has lots of new funky features, yeah, but the underlying brains, the thing that is doing the compute and spitting out the answer, hasn't moved forward. Then OpenAI launched 4o Mini, an even faster and an even dumber version of their AI. The reason these versions are coming out is because they are cheaper to run. When you're constantly saying that your company is about to invent general artificial intelligence, the new models are going to be 10, 100, a million times better, it kind of looks strange that you're wasting your time building massively dumbed down models that burn a bit less money. GPT-4 came out in March 2023. That's almost a year and a half ago now. Does it seem a bit odd that in that year and a half, the focus for OpenAI has been on cutting costs instead of releasing these apparently exponentially smarter models? Nvidia is currently valued at around $2.75 trillion. In their Q1 earnings report, they made $14.9 billion in net income, up 628% year on year because Nvidia has been able to sell their GPUs for AI for 4 times the price. If you annualize that most recent Q1 income, the latest data that we have, that means Nvidia stock is currently trading at a P ratio of 46. So the assumption is that this is just the start. These huge numbers are just the start of an even bigger growth cycle, and demand for Nvidia chips will continue to be sky high for many, many years, decades to come, and they'll be able to continue selling these chips at a huge markup with no competition emerging. It's a bit easier to see the absurdity with Nvidia because pretty much 100% of that company valuation is being driven by the AI hype. It's much harder to strip out the AI component of Google's or Facebook's or Microsoft's valuations. And the stock market is beginning to ask the question of whether these valuations have gone a little too far. Is this just a small correction? Will the AI hype wave keep going for the rest of this year? Will it keep going for 2 or 3 or 5 more years? Or is this the start of the AI bubble bursting?